Okay, let's keep doing this, Steve. It's pretty interesting. For more on all this data, I want to bring in Hamdi Yuvava, senior U.S. economist at BofA Securities. You're sitting there with Steve. What do you think of what you just heard?
I think this is a very, very impressive GDP report. As Steve correctly pointed out, 8% essentially nominal GDP growth. Consumer spending really beat expectations. This is pretty unusual. I mean, we had the monthly data for July, August, and September, so the only thing left was revisions, and the revisions were huge. Otherwise, you can just take the July, August, September number and get 2.7% consumer spending growth. So the fact that we went to 3.5 on consumer spending suggests that the revisions were quite aggressive, and the other components were also probably pretty good to get to 4.3%. I mean, we wrote in our year-ahead piece that the economy rarely grows below 2% when we're not in a recession, and yet the Fed keeps saying that 1.8 is the trend growth rate, but looks like we'll get another 2 handle this year.
There's another conclusion we need to make to this, Aditya. I want to get your thoughts on this. Getting back, Joe, to the very interesting report I did at 7 a.m.
Yes.
I'm joking because Joe was suggesting it may not
No,
be
you said it was going to be interesting. I said, you're kidding.
This number, 4.3% GDP growth, in what has been tallied as the worst quarter for employment growth since 2019, suggests
productivity growth is off the charts.
Off the charts productivity growth.
Yep.
Now that, by the way, just to contradict myself from 2 minutes ago, is a depressing thing for interest rates and yields and inflation.
Not necessarily.
Go ahead.
So productivity is disinflationary, but stronger productivity growth also means your neutral rate is higher.
Okay.
So it kind of goes both ways.
Let's bring Rick in on this.
As the market continues, nothing great, but I mean, nothing big sell-off, but it's not up on it. What do you say, 8%? 8% nominal?
4.3 and 3 and change is nearly 8,
it's almost 8%. And that, Rick, that's solely because that 3.8% was not great for inflation.
Right. I think so. But I think, the equities really are kind of moving to their own tune. They've been very aggressive. So one could say that they've already had some significant move to the upside. Right. But I do think that what we are all underestimating here is the growth factor is the only saving grace for deficits. And I don't mean to, be disparaging to the administration, but they're trying to do a lot of good things, but one of the things that I don't see is any significant effort to bring deficits or debt down. And I think at least if you're looking to try to find a variety of ways to boost growth, which I think President Trump and his administration is doing, at least this can negate some of those negatives.
Let me come in with the investment numbers, which they're good, but they're not great. Non-defense capital goods X aircraft up 0.5, and I believe that was from a 1.1. Aditya, one of the things that's out there is this huge investment in AI. Yep. Do you see it showing up? Where would you look for it in the GDP accounts? I looked in equipment, it was okay. I looked in some of the other. Is it showing up yet?
Right, so the 3 places you would look within structures, you would look at data centers, within equipment, you would look at information processing equipment, and within intellectual property products, you would look at software. If you add those 3 components up, they added 1 percentage point to GDP growth in the first half of this year. That was not sustainable. That was probably related to some front running ahead of the tariff. So we were expecting a little bit of payback. I wouldn't say this means that the AI boom has ended. It just means that the levels of investment somewhat normalized and we should resume pretty strong growth going forward.
Okay, so structures were down 6.3 after being down 7.5. So we really haven't seen it show up in structures. Equipment was up 5.4%. So it's showing up in equipment, and then just the intellectual property part is up 15 in the second quarter and up 5. That's another strong number in a row. So those are the 3 areas where we're seeing this boom show up, but it should show up more, don't you think?
It should continue. There was a little bit of a level adjustment in the third quarter that's consistent with what we were expecting. And then in terms of the way the markets have responded to this, I would just say that the third quarter is pretty old news now. We're not used to getting the first print of third quarter GDP just before the new year.
You have Fed futures?
I was just about to look at it. Why don't you go to Andrew and I'll give you a calculation.
There's no more.
That's where I was going to go with this, Steve, which is
it's coming on my screen now.
I want you to be Jay Powell now, or this board. You see this number. You think about all the things that have been said, even in the past couple of weeks, by this Fed and so many different Fed board members. What do you think they're thinking now?
I will give you the numbers. Look, the operative phrase right now for Fed policy is well-positioned. Well-positioned means we're cool, hanging and waiting and pausing in January to see how the data come in. And so no January. We're down. I think this is a low for the contract, just a 16% probability for January. I'll do some math here, add 39 and 5 and come up with 44% probability of March. And then 44 and 16 or so, you're about a 60% chance for a cut in April, and that's where we're at right now, and it's down from where it was, but that's kind of, as Rick has always pointed out, be very careful looking through one to the other. But right now, pause is what's built into the market, and this strengthens this number, this strong number strengthens the case for a pause in January.
If they don't know January, how can they know April? That's stupid.
That's the point. But the market is out there putting dollars on the line. Did you want to comment quickly on Fed policy and the outlook?
Yes, I think what the Fed's going to say is we don't have a GDP mandate. That's what Powell has said this entire while. So it's going to come down to the unemployment rate. If you print a 4.7 or higher in December, they're going to go again in Jan. If you print a 4.5 or lower, they won't go.
Where was the inflation? Is it like in something good, like wages?
It's in goods. Goods were negative. Now goods are running about 1.4% year over year. But we're not seeing it pass over, at least in the data we've seen, into services. We don't have a clean look because of the way the BLS put the CPI together this month. We're going to have to wait a couple months or maybe till January till we get a clean look. But I think the story here is that the outlook for Fed policy is one where it will pause. And just a very quick note here, I don't know, but this maybe suggests either that consumer spending for the holiday season will be better than we thought, or possibly they did a little bit more shopping ahead of time.
So what we're seeing in our card data for the holiday season is it was decent. It was not spectacular, but it certainly wasn't terrible. And it's coming off of a very unfavorable base effect in the sense that you had a big surge last year. So if you look at year-over-year rates, they'll probably be a little bit softer than you would otherwise expect. So I would say you're probably going to get a high one handle or a soft two handle on consumer spending for the fourth quarter, if I had to guess now with very little data.